Good morning. My name is Veronica Iomi and I'm the Secretary General of IMMFA. As we all know, a lot has happened since I spoke at the ACT conference in February last year. What I'm going to do today is give you a brief update on money market funds in Europe from IMMFA's perspective, in particular focusing on the impact of the COVID-19 pandemic, how money market funds fared the storm, and looking forward, what might be on the horizon and what we're focused on at IMMFA as a voice of the money market fund industry. For those of you who are not familiar with IMMFA, you'll see on slide 3, IMMFA is the Institutional Money Market Fund Association. Originally formed over 20 years ago, our core objective is to promote and support the development and integrity of the money market funds industry. We do this by engaging with policymakers and regulators, educating investors, providing regular data, and overarching all of this, providing a centralized point of contact, information and expertise for relevant stakeholders. If we look at where the industry currently is, you can see an overview here of the total assets under management of money market funds in Europe by type. As we know, the money market fund universe in Europe consists of the variable VNAV part and the constant NAV or LVNAV part. The VNAV industry is predominantly French funds. The green section in this chart is the VNAV fund industry as of the end of the first quarter of this year. The other larger share consists of IMMFA money market funds, here shown in their free currencies. Orange is US dollars, grey is sterling, and the blue is euro. Over 95% of these IMMFA funds are low volatility LVNAV funds, with some public debt CNAV funds. Both types are stable net asset value, as opposed to the variable net asset value in green. As you can see with regard to IMMFA money market funds, US dollar funds are the largest, followed by sterling and then euro. You can also see that both VNAV and LVNAV sectors have grown steadily over recent years. These pie charts in the next slide show the specific investor base for IMMFA money market funds as at the end of 2020. In the chart on the left, we show geographic distribution. Geographically, perhaps unsurprisingly, the UK accounts for a very high percentage of IMMFA fund distribution, over 40% shown here in dark blue. This number also reflects the size of the sterling money market funds that account for around 1/3 of IMMFA funds. Just under 25% is sold to investors elsewhere in Europe, including Switzerland. The slice of the pie chart in green, labelled Other European, represents distribution via third-party platforms. Finally, as you can see from the lighter blue section, approximately 18% of funds are sold outside Europe. In the right-hand pie chart, we set out the types of investors. Here you'll see that corporates represent the largest investor type, accounting for 1/3 of all distribution and an increase of over 4% since the previous year. Pension funds are a significant part of the fund category. Third party, 20%, is where money market funds are sold over platforms in Europe. As you can see, insurance companies are also very active, constituting 7%, as are financial institutions, which could be entities such as private banks or securities lenders. Public sector investors include entities such as local authorities, charities, and universities. As you know, the 2017 EU money market fund regulation introduced new fund categories and enhanced investor protections, in particular with respect to the 2 new constant net asset fund types, LVNAV money market funds and public debt CNAV money market funds. These are detailed in this slide for reference. You'll see in particular minimum daily 10% and weekly 30% liquidity requirements, and linked to these liquidity thresholds, fees and/or redemption gates in prescribed scenarios for LVNAV and PDCNAV money market funds. This link will be important in our considerations later. So having set out the lay of the land, you may be wondering, how did money market funds weather the COVID-19 storm last year? In the next slide, as we all know, the COVID-19 pandemic last year rapidly led to an unprecedented economic shock, which resulted in severe liquidity pressure in global financial markets. Like all financial markets, the money market fund sector was impacted. Unlike 2008, this was not a credit crisis, but a systemic liquidity crisis. The quality of money market fund assets was not affected since IMMFA money market funds own very high quality, highly rated paper, as we've discussed. Many money market funds initially faced increased redemptions. These were driven by investors' unexpected need for cash as the impact of lockdown began to be felt, including financing needs and increased margin calls due to market volatility, combined with the so-called bright lines arising from the link between liquidity buffers and fees and gates. This situation was exacerbated by challenging liquidity conditions in the secondary markets. Indeed, the lack of market intermediation highlighted the interconnectivity of money market funds with other parts of the short-term market ecosystem. As we go on to show, notwithstanding these challenges, money market funds proved resilient in the race for cash. This next slide expands on what happened to assets under management during the course of 2020, expressed in euro. We've included 2019 year-end for context to show the typical year-end dip which money market funds expect and prepare for. You can then see a very gradual uptick to a new peak in early February of last year, prior to the pandemic in March, when assets under management dropped sharply. In the third week of March, they dropped 5%, but since then recovered and continued healthy growth, hitting a peak of 890 billion euros in July. We feel that this shows continued investor confidence in the underlying money market fund operating model. And in this respect, this crisis was very different from the 2008 global financial crisis, where investors were worried about their credit exposure. In March of last year, it was not about credit concerns. It was about investors needing their cash back for reasons that could not have been foreseen. As we can see here, once they had cash again, they very quickly resumed investing in money market funds. Whilst there was a net outflow in March, experience varied by fund type and by fund currency. Here we can see the LVNAV funds by currency. US dollar funds were the worst hit, dropping 22%. US dollar funds tend to be more influenced by US norms and behavior because there's often a connection between the domestic and the offshore investor bases. In the US market, some of these outflows were investors switching into other money market funds, which we'll look at in a moment. The sterling market in the third graph here reacted a little bit later, falling 8% over the course of a week, before recovering its losses the following week. Euro in the center graph was different again. Euros went into the crisis on a strong uptrend, so had a bit further to fall, 15%, but also recovered very quickly. As I just mentioned, US dollar funds saw the most pressure. This reflected the US market, where even in the most liquid markets in the world, US Treasuries was impacted. In the US domestic market, there was a pronounced move out of prime funds and into government money market funds, and this shift was also reflected in Europe. So the blue line here in this slide is LVNAV US dollar money market funds, our equivalent of the US prime fund, although the US prime fund is VNAV, and the red line is PDCNAV, our equivalent of the government fund. As you can see, redemptions from LVNAV funds were mirrored by inflows into PDCNAV fund. So this money was not leaving the money market fund sector, it was just transitioning to a lower risk fund type. This option was less viable for sterling and euro investors, as PDCNAV funds do not exist at scale, except in US dollars. So turning to the next slide, how did money market funds fare in the COVID storm? Well, first and foremost, money market funds were not the source of disruption. As explained earlier, the money market fund regulation in Europe introduced a number of more prescriptive protective measures designed to make funds more robust. Of course, the COVID crisis put these mechanisms to the test. We're pleased to report that money market funds proved resilient in the storm. Despite the exceptional and adverse market conditions, IMMFA money market funds were able to meet redemptions in full and on time, and no gates or fees were imposed. In other words, they continued to serve their purpose of protecting capital and providing liquidity. At the same time, the crisis highlighted some areas where regulation did not work as intended, and above all, the interconnectivity of short-term markets. Most importantly, notwithstanding the challenges, once markets normalized, assets under management increased again, reflecting investor confidence in the underlying structure, including the dominant LVNAV category. Indeed, that liquidity combined with transparency is particularly appreciated in the current environment. So while the COVID storm seems to have calmed down, you may be wondering what is on the horizon. In the aftermath of the storm, and taking into consideration that all financial markets experienced great stress due to the COVID-19 pandemic, several work streams have started at an international level, led by the Financial Stability Board in collaboration with the IOSCO, to evaluate the effectiveness of post-global financial crisis reforms. The aim of these work streams is to assess the ongoing resilience of all financial markets and draw lessons from the crisis and on the roles played by markets, investors, and regulation, with a view to proposing potential reforms where needed. Among the areas under review are money market funds. In particular, this international work highlights the importance of having a common view on the role that money market funds should have in the financial system and the economy as a whole, as a precursor to agreeing policies to enhance resilience in the sector, if and where needed. As you'll see from this timeline, the FSB's money market fund policy work started at the beginning of this year. Its technical expert group, comprising prudential and markets authorities, including at a national and EU level, is currently analysing the pros and cons of a range of options that have been identified. As we'll consider shortly, a number of these are included in the US SEC President's Working Group report on money market funds published in early February and the recent ESMA consultation paper. Taking into consideration the findings of this work, the FSB will publish in collaboration with the IOSCO a report looking at different options of reforms for money market funds over the coming weeks, to be consulted publicly ahead of being finalised for the G20 meeting in October. In parallel, work has also commenced at an EU level. As explained, since 2017, European money market funds have been governed by EU money market funds regulation. This regulation was aimed at enhancing financial stability within European markets and increasing investor protection. The regulation contains a review clause requiring the Commission to review the adequacy of this regulation by the 21st of July 2022, including whether changes are to be made to the regime for public debt CNAV money market funds and LVNAV money market funds. Here we can see the expected timeline of work for this review by the key EU authorities. In anticipation of this review, ESMA launched on the 26th of March this year its consultation on potential reforms of the EU money market funds regulation. This is aimed at reviewing the overall regime, including roles played by markets and investors, and takes account of lessons learned following market stress experienced during March of last year. So what are the current options on the table at an EU level, and how do they marry with others that may be being considered at an international level or in other key jurisdictions? As we can see here from the arrows, several of potential reform options proposed by ESMA are similar to those in the US SEC President's Working Group report published earlier in the year. What I'm going to do over the next few minutes is just touch on what we think are the top 3 key options being proposed. The first option, which is new and one which we included in our recommendations last year, is decoupling. Now, you'll recognise these examples of uncoupling, but what does this mean in the context of money market funds? This relates to the uncoupling or delinking of liquidity thresholds from the imposition of fees and gates, as explained here. While we're very supportive of the money market fund regulation, it has enhanced transparency, consistency, and significantly improved resilience as borne out in the COVID crisis. This is one area which we think could be improved to make money market funds more resilient. Although the regulation allows for a fall below the 30% weekly liquid asset requirement in LVNAV money market funds, In practice, the threshold has become a bright line, limiting a manager's ability to manage liquidity with optimal flexibility and in the best interests of investors. We agree with ESMA's analysis that the reforms brought by the money market fund regulation to liquidity thresholds for PDC NAV and LV NAV funds, which tied a breach of these thresholds to the use of fees and gates, inadvertently resulted in their becoming pro-cyclical. As evidenced in March last year, these liquidity buffers designed for times of stress actually became unusable during the crisis. Removing the link between the liquidity thresholds and imposition of fees and gates would, we believe, enhance the overall resilience of the sector by reducing incentives to redeem. It's important to note, though, that with delinking, we are not suggesting lower levels of liquidity nor less transparency. Moreover, money market funds would still have the ability to use fees and gates under applicable UCITS provisions. Delinking in the regulation would simply help to remove what has become a bright line. Turning to the second option on the table, they often say a picture paints 1,000 words. Now, this painting, one of my favourites by Fragonard, may seem frivolous, but is actually rather complex and full of symbols. In the same way, swing pricing, which is commonly used across a range of funds in Europe, might seem a simple solution for reallocating liquidity costs to redeeming investors, but not so for money market funds. In particular, money market funds which offer same-day and intraday settlement, such as LVNAV and PDCNAV, which is a core benefit for investors. This is explained here. Furthermore, LVNAV and PDCNAV already hold substantial levels of liquidity, 30% weekly liquid assets, 10% daily liquid assets, unlike longer-term funds which either do not settle same day or offer only one valuation point, are typically fully invested and therefore rely on selling assets to meet redemptions. There are many other reasons why swing pricing is not appropriate for LVNAV and PDCNAV money market funds, including the fact that they have portfolios where bid or offer spreads are tight under normal conditions and where regulation already requires that assets be valued on the more prudent side of bid. Hence, there is effectively nowhere to swing to. What's more, LVNAV money market funds already have liquidity management tools in the form of liquidity fees at their disposal, which could achieve substantially the same result as swing pricing. This would enable the board to apply liquidity fees to redemptions that adequately reflect the cost to the money market fund of achieving liquidity and ensure that investors who remain in the fund are not unfairly disadvantaged. The third key option on the following slide, which I'd like to highlight, is moving all money market funds to VNAV and doing away with the public debt CNAV and LVNAV fund structures. We do not support this option for a number of reasons. As we all know, the market events triggered by the pandemic were exogenous. They were not a question of fund type. Moving to the variable mark-to-market asset valuation is not the solution to a systemic liquidity event. The experience of money market funds during the March crisis does not indicate that VNAV money market funds are more resilient. Indeed, as we witnessed during the March period, fund behaviour was not homogeneous either by type or currency. Both US prime funds and Euro standard money market funds, which both operate with a floating NAV, also experienced significant redemption pressure. From a utility perspective, the more conservative features of the LVNAV structure are valued by many investors, either because they may be required to invest in stable NAV money market funds in line with their internal investment procedures. Such funds are often treated as cash equivalent from an accounting perspective, or because LVNAV funds are more practical for sweeps, intraday settlement, and trade execution. Changes which reduce the availability or attractiveness of LVNAV money market funds would be likely to lead to a shift into government money market funds, as was seen in the US post-reform. This is problematic given the lack of scalable alternatives in euro and sterling. It would also increase demand for government securities and commensurately reduce demand for credit instruments, which in turn could have significant implications for the supply of private credit to the real economy. Above all, though, we believe that the investor base in Europe is best served by a spectrum of funds which offers choice. The European money fund reforms were successful in preserving investor choice and ensuring continuity. As you saw in some of the earlier slides, investor flows since the regulatory reforms in 2017 show strong support for the LVNAV structure. Continued growth in LVNAV assets under management since the events of March last year also demonstrates the ongoing appeal of the LVNAV category. Well, you may be wondering, what role are we at IMMFA playing over this challenging period? Well, looking at this next slide, throughout we have in our regular dialogue with central banks and regulators been providing intelligence and data from the outset of the COVID crisis. As a voice of the industry, we've been actively contributing to the post-crisis analysis. Early in July last year, we issued a detailed IMMFA position paper setting out our assessment of the impact of the COVID-19 pandemic on the European money market fund sector, the key findings of which we've already covered in previous slides. Our findings helped to shape some of the thinking of key authorities such as IOSCO in their subsequent reports. We followed our position paper with some IMMFA recommendations, covering areas which we feel merit further examination, and these are included in the themes listed in the fourth bullet here. As already mentioned, one of our recommendations has led to the proposal for delinking at an international level and in the recent ESMA consultation. Another point we've emphasised in our recommendations is the importance of understanding money market funds in the broader ecosystem. The solution to a market-wide liquidity event is not a matter of intrinsic fund structure, and finding any solution must involve a holistic review of the context, taking account of the fact that the issues which arose during the COVID storm had a system-wide impact across all major market sectors, not just money market funds. This point has been taken on board, and a separate work stream within the ongoing FSB IOSCO assessment is dedicated to examining potential reforms for enhancing resilience across the broader ecosystem. And all along, we've been continuing to engage with regulatory and policy stakeholders at a European, national and international level. From the beginning of this year, our focus has been in engaging with key stakeholders in the FSB IOSCO work, in particular prudential and markets authorities and the technical expert group, which is currently assessing the range of options being considered. In doing so, we've involved investors in money market funds to ensure their view is heard on the utility of money market funds and the importance of preserving investor choice. We will, of course, be responding to the ESMA consultation and forthcoming FSB consultation. And in all our engagement, we're continuing to coordinate with other relevant industry associations, including investor associations such as the ACT. So to conclude, EU money market funds regulation has brought greater transparency and consistency for investors. It has also increased the resilience of money market funds as borne out in the COVID crisis. That being said, the crisis has revealed areas where enhancements could be made to the regulation, such as delinking fees and gates from liquidity buffers. Although money market funds were stressed in the recent crisis, they were not the source of market dysfunctionality. Increased assets under management illustrate their continued appeal and growth, notwithstanding the pandemic. Their importance to the real economy is generally recognised. It's likely that there will be regulatory changes at a global level, and of course, these will influence the 5-year review of EU money market fund regulation next year. And in all of this, IMMFA's role as a voice of the industry is ever more important in helping to shape the current debate and way forward. Thank you.